If you are a law firm owner and you know your revenue, but you still feel constant pressure around cash, payroll, or owner distributions, then let's talk about that. So, I want to start with a hard truth that surprises a lot of firm owners. Revenue is not a financial metric that tells you how healthy your firm actually is. So, revenue is an outcome, it is not a diagnostic tool. I regularly work with law firms doing 1 million, 2 million, and even 3 million in annual revenue who feel financially unstable. And when we peel back the numbers, the issue is almost never a lack of demand or effort. It's missed metrics. So today I want to talk through the three law firm metrics that explain why revenue alone is not enough and how missing them quietly will drain cash out of your firm. So revenue answers one question only. How much work did the firm invoice and get paid? What it doesn't answer is how efficiently was your work produced? How much of the work was actually billed? Or how long did it take to turn that work into cash? So without those answers, you're running your firm blind. So let me give you a common scenario. A law firm reports $100,000 in monthly revenue, and on paper that looks strong. But the owner is delaying distributions and stressed about making their tax payments. The problem is not the revenue. The problem is what happened before and after that number. And that's where missed metrics come in. So let's talk about metric number one, utilization. So utilization tells you whether billable team members are actually producing billable work. The formula is the number of billable hours worked divided by the number of available billable hours. So here's an example. An attorney works 160 hours in a month and bills 120 of those hours. So their utilization is 75%. So for most law firms, healthy utilization generally falls between 75 and 85%, depending on their role and practice area. If utilization is low, revenue problems start before billing even happens. No amount of marketing or collections will fix hours that were never billed in the first place. When firms do not track utilization, they often assume people are busy because everyone feels overwhelmed. But busy and billable are not the same thing. Okay, so metric number two, realization. Realization tells you how much of the recorded work actually turns into billed revenue. And so this formula is the amount of billed revenue divided by the value of recorded billable time. So for example, $100,000 of time is recorded. So add up your time tickets, it works out in your system, calculates out that's $100,000 of time. But when you look, only $85,000 is billed. That means your realization is 85%. Most healthy firms should target realization between 85 and 95%. So low realization usually points to delayed billing, excessive write-downs, unclear scope, or discounting that happens without visibility. So this is one of the biggest silent profit leaks I see. The work was done, the revenue potential existed, it just quietly disappeared off into the sunset. Okay, so metric number three, lockup. Lockup explains why law firms with good revenue still struggle with cash. So here's the formula. It's your number of days of WIP plus your number of days of accounts receivable. So literally from the time you completed work, how many days did it take you to issue a bill for the work completed? And then from the time you billed the work, how many days did it take you to collect that? WIP days measures how long work sits before you're billing it. And AR days measures how long from the billed invoice it sits until it's collected. So for example, if you have 45 days of WIP plus 75 days in AR, that's 120 days of lockup. That's insane. That's 4 months from when you do the work until you get paid. 4 months. Most firms should aim for a total lockup between 60 and 90 days. And obviously, if you can get that lower, all the better to you. When lockup stretches beyond that, cash gets trapped. Owners feel the pressure, even though the P&L looks fine. And this is where many law firms mistakenly blame expenses when the real issue is timing. So let's talk about how these three metrics work together. And here's why revenue alone is misleading. So you can have strong utilization, but weak realization. Or you can have strong realization, but slow collections. Or unfortunately, you can have all three metrics underperforming at the same time. Revenue will not show you which of those is broken. So a couple of years ago, I worked with a law firm that reported consistent monthly revenue, but had their lockup over 120 days. Again, that's 4 months. Once we fixed the billing timing and accountability on the collections, cash flow stabilized within 90 days with no increase in cases or workload. The firm didn't need more revenue, it needed better visibility into its numbers. So if you're a law firm owner, you should be able to answer these questions at any time. What is our current utilization by role? What is our realization rate this month and last month? How many days of lockup are we carrying right now? And if you can't answer these, revenue is giving you a false sense of control. Start tracking these metrics monthly at a minimum. Weekly is even better once you get systems into place for reporting and capturing that information. The goal is to do better today than you did last time you measured these numbers. The numbers are going to tell you where to focus before cash problems turn into stress, burnout, or bad decisions. My point today is that revenue feels good, but metrics create stability. If this video was helpful, be sure to subscribe for more practical financial education, specifically for law firm owners. And if you want help identifying which metric is costing your firm the most, that's exactly what I do as a fractional CFO for law firms. Thanks for watching.